All right, guys, welcome back to this video. What we're going to talk about are a number of factors and variables that go into any type of investment that we make. There are 5 that I'm going to talk about today. There are, of course, more, but 5 that I'm going to talk about today. There's risk and reward. There's time, control, and capital. So let's first start with risk and reward. There is risk inherent in anything that we do. Any investment carries risk. Any decision we make on a daily basis, it carries risk, okay? And we either take the risk or we don't. If we choose to take it, it's because the reward at the end is desirable. It's something worth risking whatever we were risking to get that thing. All right. Sometimes either the reward is big enough or the risk is small enough that we're okay taking the risk and moving forward. Okay, so let's talk about a simple example. Getting into a car and driving anywhere is a risk. Let's say I want to go to the store and pick up some groceries and it's across town. That's my reward, right? I get groceries. So the risk is I drive in my car, the reward is I get groceries. Okay, let's talk about it. The reward, not a huge reward, to be honest, right? It's nothing to get me out of bed except that I need to eat. Okay, so it's not a huge reward. On the risk side, I could get into a car crash. I could be injured or die. That's a pretty substantial risk. The odds of that happening are maybe fairly low, okay? Especially across town, I'm comfortable in this environment. I've lived here for a long time, right? And so the reward is not huge. So that means that the risk we need to mitigate to feel good enough to take the risk to go get that thing, for me to go get groceries. So we can mitigate risk, I can, in a number of ways, okay? Number one, like I mentioned, I live here. I've lived here for a long time. I've driven the same roads for a long time. I'm very comfortable. Number two, I'm going to wear my seatbelt. Easy thing to do. Even if I get in a wreck, it's going to protect me. I have airbags in my car. I'm going to obey traffic laws, right? I'll stop at red. I'll obey the speed limit. I'll signal with my blinker. All of those things that I can control. And if I do those things, then I'm even mitigating my risk more and more, to the point where going to the store to buy some groceries doesn't even compute that it's a risk. Okay. It's like, yeah, normal, totally fine. Okay. It's because I've done all these things to mitigate the risk, and I've done them subconsciously because this is something we do all the time, right? I've done them to the point where I don't even have to think about getting in the car to go drive to buy groceries. Okay. So a small reward in groceries, but the risk is relatively small. I've mitigated a lot of the factors, and some of the other factors are not impactful enough to stop me from taking the risk, getting in my car and going to the store. So risk, reward, okay? At times, there might be a reward large enough that I am willing to risk. I understand the risk is big. I could lose big, but the reward is big enough that I'm going to go for it. Let's think about in terms of a relationship, for example, okay? Let's say I met somebody, I like them, and I want to ask them out, or I want to pursue a long-term relationship with that person. The reward is big, right? A long-term committed relationship is great. There's a lot of risk, right? There's a lot of risk of maybe I spend a lot of time, maybe I spend a lot of money, and most of all, I spend a lot of, emotional energy. And the risk there is that all goes to waste. The relationship fails, and now I am out time, I'm out money, and emotionally, I've had my heart broken, right? And now, emotionally, it's a huge loss. But I'm willing to engage in that because the reward of having a long-term committed relationship, that is a reward I really prize. I really want that. And so I'm willing to risk these things to go after it. Okay, so 2 really basic, kind of simple ideas, but demonstrate how risk and reward work together. Okay, so with any investment that we approach, there is an element of risk. No matter what anybody says, there is always risk involved all the time. Now, the risk could be lower or higher, but it's always present. The lower the risk, the lower your potential returns, your potential gains, and the more limited your potential losses. Okay, so if we think about it like this, with any investment, there's a range of gains and losses. Okay, a ceiling, and a floor. And if we have an investment that's low risk, that range gets smaller. And so the potential gain, we hit a ceiling sooner. Potential loss, we don't lose as much. We don't stand to lose as much. And it could bounce up and down in this range right here. If you increase the risk, if you dial it up, this range gets bigger. And all of a sudden, the variability between the ceiling and the floor gets bigger. And so you could have a potentially higher reward. You're setting your ceiling higher by taking more risk. You're also lowering your floor. Okay, so you could make it big, you could lose substantially more than you would have otherwise. So the risk is always there. It just impacts the range of gains and losses. Okay, so you'll hear quite often as people talk about this strategy or that strategy for building wealth. Maybe it's in real estate, maybe it's in the stock market, maybe it's trading, maybe it's crypto, whatever it is, they're going to accentuate the positive potential for you and de-emphasize the negative. So you're going to look at this range and they're going to focus on this portion and leave out this portion. And they're going to act like it's a lower risk type of thing, like it's a sure thing and all that type of stuff. You see the rhetoric out there constantly. Fact of the matter is, the wider this range, the higher the risk, period. Okay, that is always the way that it is. Now, we have more controls that we can put in to adjust the risk slightly. So maybe we can keep a similar range or even raise the floor a little bit of what our losses could be or lower risk slightly and keep a same return potential. Okay, it is possible. There are certain factors within our control we can do that. We'll talk about some of those. But generally speaking, the wider this range is, the higher your expected return, the lower your losses could be, right? I mean, the floor. The higher your losses could be, the lower this floor goes as far as losses, and the amount of risk is dialed up. Okay, so don't let anybody fool you. Some of the factors that go into this, though, are time and control and capital. To mitigate this risk and adjust the range, limit your downside, you can put in a lot of time. And the more time that you put in, the more control you have on the outcome. The less time you put in, the less control you have on the outcome. So that's time. Now, this could be time in the investment, okay, like time invested in that thing. It could also be time that you personally spend ensuring the success of the outcome of the investment. Okay, so it could be your time that you've invested into the thing or the amount of time that you're invested. Okay, so that's subtle, but there's kind of two ways there. Control is another one. Well, actually, let's talk about time for just another second. If you are going to own a business, okay, and you're going to invest profits back into the business and grow the business, there are obviously a number of factors that go into business success, but the more that you control the variables, the more that you control the outcome. So as a business owner, you might put in a lot of hours, you might put in a lot of your time to ensure the success of your business. That doesn't guarantee its success, but you can certainly have more of an influence on the outcome and make sure that it's positive than negative, okay? Somebody can put in a ton of time on their business and it still fail and they still sustain all the losses, totally possible. But the more control you exert over it in terms of time, how much time you put into ensuring its success, the higher the likelihood of a positive return, okay? So time involved. This is very common, for example, in real estate. Sometimes buying a rental property, sometimes you can get a relatively higher return. There's a lot of factors going into this, okay? Obviously. So your market, timing, there's a ton of factors. But let's just assume, generally speaking, that a rental property, you might actually get a pretty decent return on that. If you want a higher return, then you will spend your time ensuring that the return is higher. So how do you do this? Maybe you personally, as the landlord, repair, make all the fixes and all the repairs that are necessary. Maybe you do the maintenance, like you mow the lawn and you take care of this and that. Maybe you spend the time personally to vet potential tenants and select the best one. All these things you can put in your own time. And by doing so, you might get numerically a higher return, okay? Because you're spending less money. It's just your time that you're spending, not money. So maybe your return is actually pretty decent. But as you start to limit your amount of time and put in money instead, then you start to lose a little bit of the control there of that outcome. So let's say that you don't want to spend as much time on it. You actually want to hire a property manager to do all that for you. Well, that's a cost. Now you're not spending time, but you are spending money. And ultimately, you're lowering your return on that investment, okay? Because you're not going to unclog the toilet and you're not going to do this. You're not going to do that. You're paying somebody to take care of it for you. So you're lowering your financial return in order to preserve your own time. If you invest more time into it, then you can increase your financial return. Right. So that's in regards to time. Now, control. Control is important, right? If you outsource everything to a property manager, you don't have as much control over how they do things. The vendors they get, the contractors they get to go fix this or fix that on your property, you might not like. They might not be highest quality and they might be more expensive. You don't have control over that. The property manager has control over that. You don't have control over the tenant you pick. The property manager is handling it. Maybe they pick a bad tenant. Okay, you lose control of that process to some degree. And so again, maybe to have more control, you do those things instead. You ensure you find the right tenant. You find the contractors or you do the labor yourself. And so you exert more control and you have a higher influence, a more impactful influence on the outcome and the return. Okay. Same thing in a business. You can run the business. As soon as you hire employees or try and offload things to your plate, you start to lose control over the success of your venture. Maybe you hired the wrong person and it stops your progress or slows you down for months or a couple of years because things were not happening. So we've had those situations. Everybody has. Maybe you've been back in college when you're in a group and they put 5 random students together to go do this group project. You have less control over the outcome because the other people still have to do their part and they have to do it to a high quality, a high standard in order for you to get a good grade. Whereas if you're doing this paper on your own, yeah, you have to put in more time, but you have higher quality control. Okay, so control is important. In the stock market, as another example, you have fairly little control over the outcome. You might do a lot of research and select a company you think would be a good company to invest in, but ultimately they have to perform. Market conditions have to be such that they can succeed and progress as a company, so on and so forth. So you're giving up a decent amount of control to invest in a company that's already rolling, like Apple or Google or Tesla or whatever, and you're just trusting them that they're going to do a good job and that you'll get a good return. The opposite side of the spectrum is you start your own business, you control everything, but you have all the risk. So you can kind of control the outcome, but you're putting in all of your time and capital to make that happen. So your return potential is maybe higher in your business, but in the stock market, you don't have to put any time. It's just capital. You don't have any control. So the returns are going to be lower. I mean, you just don't have much influence over it. So that's control. And then capital. If you don't have the money to go do something, generally speaking, you need to put in the time to do something. Okay. If you have the capital, then you don't have to put in the time. So one example of this, again, let's use real estate. Let's say there's an apartment complex that I want to go build or that I want to purchase, but I don't have any money. Well, I can partner with somebody that does have capital and I put in all the time to make the deal happen and make it a success. And we partner up. I put in the time. I have a partner that puts in the capital, and then we've got an investment. So you're taking a very active role, dedicating all of your time and energy to making that happen. Whereas a person with capital gets to put that in and trust somebody else to do it. Okay, so this is what happens commonly in syndications. We'll get to that, or different funds like investment funds. Essentially, there's a capital partner and there's the partner that's going to put in all the time and all the work to make it successful. Okay. On a very large scale, that's what mutual funds are. You're a capital partner, right? Even with your $100 or your $1,000, you're a capital partner. You're putting into the fund and you're trusting that the person or team in charge, the fund manager, is going to do a great job. They're putting in the time, they're putting in the effort to make the investment successful. You're getting a return with putting in none of your time, essentially. So there's capital partners. You can decrease the amount of time by having capital. If you don't have capital, you likely are going to have to increase the amount of time you're spending on something, okay, in order to get a return. So risk, reward, time, control, capital. We'll talk about these concepts throughout. I hope this was helpful to kind of conceptualize some of the different variables that really go into successful investing and wealth building. And they're going to apply to all of these in different ways. We'll examine those in the coming videos. So we'll see you guys soon.
Take note of these factors and apply them to your investments.